Lesson 1. How to stay out of debt. Debt is money owing to another person or organization that must be paid back by a certain date. Debt includes mortgages, school loans, vehicle loans, and credit card liabilities. Here are 5 methods to keeping your debt under control. 1. Learn how to use credit cards wisely. Cards are intended to make transactions quick and simple. You're not alone if you're tempted to use them for everyday purchases. Understanding how they function, on the other hand, may make it less enticing to swipe. Lending card interest rates can rise over time, and they are a sort of revolving credit. Making the minimum payment is insufficient to get out of debt quickly, since just a little amount of the payment is allocated to your principal balance. That implies it might take years to pay off your amount while costing you thousands of dollars in interest because you're carrying a load from month to month. Remember, if you took out a personal loan to pay off high-interest credit cards, that was your purpose. Paying more than the minimum monthly payment is essential for getting out of debt and staying out of debt for good, and a personal loan may help you get there faster if used sensibly. 2. Make a budget that you can stick to and that will help you save. A budget may help you regulate your spending and save money, both of which can help you avoid debt and improve your credit score. Here's how to begin creating your budget. Step 1. Record your income. Include all of your monthly after-tax revenue. Remember to include additional sources of income, such as investments, Social Security checks, or side hustles, in addition to your salary and/or hourly pay. Step 2. Add up your expenses. Begin with your obvious expenditures, such as rent and energy, and then include discretionary spending, such as dining out and clothing purchases. Don't forget to add savings account contributions and debt payments under the spending categories. Look back over the last 6 to 12 months and determine an average for costs that change, such as your monthly food or electricity bill. Step 3. Match dollar for dollar. Understand where every dime goes. If your spending exceeds your income, it's time to change your spending habits. If you discover that your income exceeds your costs, that's fantastic. 3. Be mindful of your spending habits. Making a budget will help you manage your spending, but only if you follow it. That may be difficult for many of us, but here are a few methods to help. 1. Leave your credit cards at home. Bringing only what you need makes it evident when you've overspent and makes succumbing to temptation impossible. 2. Compare your financial reality to your budget. Reviewing how much you've really spent versus what you've budgeted on a regular basis exposes the spending patterns that may be throwing you off track and damaging your objectives. 3. Sleep on it. If you genuinely desire something you don't need, give it some thought. That extra time and time away from the business may let you realize you don't actually need it. 4. Remind yourself of your goals. Consider the comfort you'll feel once you're debt-free. 5. Plan ahead. Make a shopping list to help you avoid impulse purchases. Instead of eating out, go grocery shopping or invest in a coffee machine. To save spending $5 on coffee every day, planning ahead of time might result in significant savings. 4. When it comes to new debt, be careful and strategic. The key to keeping your debt under control is to choose a product that meets your needs and to plan how you'll pay it off. You may decide it's time to purchase a house, a vehicle, or return to school, and you'll almost certainly need a mortgage, auto loan, or student loan to do it, or one day you may require credit to assist you in the short term, such as paying an unforeseen expenditure or boosting your regular cash flow. When determining which product is ideal for you, consider the following. 1. What does the entire loan cost? 2. Don't mix up interest rates with APR. The best number to use to determine the overall cost of your loan is the APR. 3. If you think the answer is yes, find out if you'll be charged a prepayment fee. 4. Is this a revolving or installment loan? The distinction might have an influence on how you handle your payment plan. Revolving debt fluctuates, but installment debt is ideal if you want regular monthly payments that make budgeting simple. 5. Is this a product with a fixed or variable interest rate? 6. The distinction might cost you a lot of money in the long term. A fixed rate is one that will never change, whereas variable rates can fluctuate over time. 5. Strengthen your credit score. If you ever need credit again, having a good credit score will allow you to get the finances you need at the best possible conditions, perhaps saving you hundreds or thousands of dollars in the long run. There's no excuse to know your credit score and what's causing it with free credit score monitoring and educational tools. Use Upgrade's Credit Health to check your credit score on a regular basis and receive tailored tips on how to maintain or enhance your score. Did you know that World Bank Group, or commonly known as World Bank, is the largest international financial organization, and it aims to provide assistance and projects to improve the economic development of UN developing countries. It's located in Washington, D.C.